If you're looking at a Main Street acquisition, that generally would mean 300,000 to about a $5 million price tag, then this is the episode for you.
Our goal this episode is to give you guys some information so you understand what boxes to check when you're looking for a place, how to screen a business, what makes sense on pricing, and how to make sure that you are going to be giving the proper numbers presenting to underwriters so you can get the deal done when you guys find a business that you want to actually go in on. Okay, so the first thing you guys are going to want to do when you're looking for a business is define your buy boxes. These are really the key elements that you're going to care about when identifying what business you want to buy and is it going to make sense for you to actually push forward with this acquisition. The first of these buy boxes is the geography and hours within your living range. Is it the cafe right down the street? Is it totally virtual? Or is it 5 towns over and an hour and a half commute each way?
The next thing you want to think about is your minimum SDE, or seller's discretionary earnings. What is the minimum that you're willing to accept as an annual salary from this business acquisition? Set a floor so that as you're doing your impartial analysis, you don't accidentally do a lot of work on acquiring a business that isn't going to pay you enough for the work that you're going to do for it.
The next one is, how dependent is the actual owner in the business? Is this on a scale of 1 to 5, 1 being super involved, 5 being incredibly passive? Is this the type of business where you need to show up every day, and if you're not working, the business isn't earning? Or is this a type of business where you just need to make sure that the systems that are in place are running properly and you're making sure that checks get paid on time, invoices get collected, and maybe some other high functioning owner decision making? That ties into our next box, which is who makes up the team at the organization. If there's no staff and no one else really helping run the business, then it's going to be a very owner dependent business. It's going to be a 1 on that score of 1 to 5. If there's some staff, maybe even a part-time manager, now you're going to be into the 3 range. And if there's maybe some higher level executives, maybe a general manager or chief operating officer, depending on how large the organization is, then it could be what I would consider more of a 5 in that box. And understanding who's there and who's important to keep around is going to be vital for you understanding what your role in this acquisition is going to be.
These next 2 are super important, but can be easy to miss. First, what is the regulations and the licenses that you're going to need to continue the activity of this business? You might hear people talking about go buy an HVAC, go buy a plumbing company. But the truth is, unless you are already licensed in that discipline, it can be extremely hard to find investors or a lender that's willing to provide any capital into it. Beyond that, you don't have an edge in that specific business. We want to understand, why are you going to be able to come in and not just succeed, but grow beyond this? Yes, you might be able to close a deal, but how are you going to grow? Is your niche sales and you're buying a place that has great product people? Is your specialty scaling and there's a great team in place? If they're a very unique niche that you're going to be able to expand, make sure you can understand your edge and make sure you're finding something that fits what you're good at. So you found a deal that is inside of your buy box. What next? Now you have to figure out, does this pass your 10-minute screen? So one of the first things you have to look at is, what are the 3-year revenue trends for this company? We have to understand, is this a growing company that has a lot of upside? Is this a very stable company that has very consistent top line revenues? Or is this a company that has had some ups and downs and maybe even declines over the last 3 years? Not only that, but there is still lingering residuals from the COVID era on these tax returns. So as we are diving in and looking at a deal that hit all of our buy box, we now need to understand what is the story this 3-year revenue trend is telling us. Now, that also ties in to the bottom line. What is our SDE sanity margin? After we go in and we add back the current seller's compensation, we can look to see if there's other add backs that make sense. And I'll touch back on them at the end here. But let's make sure up front that the revenue trends make sense and that at the end of the day, it's going to be paying you enough money to move forward with this acquisition.
Along with benchmarking profitability and revenue, you also want to kind of dissect what revenue is made up of. Are there maybe a small number of clients making up a huge percentage of that top line revenue? Or is it a more diverse base, having a lot of volume, which would almost protect yourself, God forbid, one of the customers were to leave? The last thing you want to do is buy a business, and after the first week of the acquisition, 30% of the revenue walks out the door. In addition to understanding the revenue cycle from a customer perspective, you're also going to want to know how seasonality works, both on the revenue side and inventory. Joe and I actually grew up in South Jersey, and a lot of my friends worked on the boardwalk in Ocean City and Atlantic City. Now, you can imagine these stores were only open for 3 or 4 months out of the year. So when it comes to running a business, you would live or die by 3 or 4 months out of the year. And if there was one bad rainy day on a holiday weekend like July 4th, that could make the business go from red to black or black to red.
After you've got a good handle on the top line, the bottom line, where the revenue comes from, and just the general fluctuations of the business, we can look to see what other add backs in the financials we might be able to consider. You'll often see business brokers being very aggressive, adding back, say, owner vehicle, meals, maybe even things as crazy as renovations to a personal residence that were done on a business balance sheet. And while, yes, we can consider those, it's always going to be important that you have a good idea of how defensible these individual add backs are. Things you can always add back is a seller's interest if you're not inheriting any of their debt. You can always add back seller's comp unless you're going to be continuing to pay them for some reason. Depreciation can always get added back as a paper expense. But beyond these standard add backs, just make sure that you understand why that deserves to be added back. Because if you're wrong, that's money out of your pocket.
Now that you've done your pass fail analysis and know that this is a business you want to move forward on, the next step is to determine how much you're going to pay for it. In the world of small business acquisitions, there's something called an SDE multiple, implying that a lower multiple means more hands-on work and a higher multiple means more hands-off. Just like we were discussing in our previous slide on the owner hours, are you going to be on a more of a 1 to 2 level, a 3 level, or a 4 to 5 level? And if you want to be more hands-off, there's going to be a higher multiple, a higher premium for that. So what we've come to see is if it's going to be a hands-on operational type of an acquisition, that's where you come into a 2 to 3x. And that's because the purchase price is going to not be that much higher than what the actual profitability of the business is, because it's contingent on you as the owner. Let's say there's some staff in place, some middle managers, and you're now managing people more so managing clients in the product. That's where you get into the 3 to 4, maybe even 5x SDE multiples. And then the last tranche is the 4 to 6x and even higher. That's where the expectation, and at least the pricing expectation, is that as an owner, you're going to be much more hands-off from the day-to-day operations. Joe and I have actually seen some deals come through where we had a 7 or even an 8 multiple on this for a multi-unit franchisee. And again, the implication for that really tied into, firstly, it was a large multi-unit systematized business and a franchise on top of that, really implying as a new owner, you are not going to be focused on the day-to-day activities of each unit. You're going to be much further removed, either just treating it as a more passive investment or focusing on a much more executive level of execution post-acquisition.
The one thing to consider when you're determining this multiple is to make sure you're accounting for replacing the seller. When the bottom line is that what is determining the total price, sometimes the multiple is easy to figure out, but there can be disagreement on what that SDE is. So make sure that you know not just what the seller is really bringing home, but also, do you have to hire someone to replace them? Are you going to be doing it yourself? And if you do have to hire two, maybe even three people to replace the seller, how does that affect your SDE?
Now that you and the seller have agreed tentatively to a purchase price, the next thing for you to do is to actually submit a formal letter of intent to buy the business. One of the biggest things that you need to do, aside from making sure these items are touched upon, is engage a good attorney. This is not the place to be penny wise and dollar foolish. Working with a good attorney to help put together LOI and the eventual purchase agreement will make sure that everything is established properly and legally. The things you're going to want to make sure you cover are price and structure. Is there going to be a seller note that's going to hold back some of the purchase price? Making sure that you have a working capital amount placed into the actual LOI so you know how much is going to be funded. A part of that too can be financing contingencies. That way, if the deal doesn't come to fruition due to the fact that it couldn't be lendable after you've made the LOI, you can walk away relatively unscathed. Other things to consider are non-competes for the seller and for any key staff that might be leaving. Working on what the transition and training is going to look like for you, receiving training from the seller, but also maybe potentially training the seller or any retaining staff on new systems you're going to implement. What the exclusivity window looks like, meaning how long are you going to keep the business off market for you to be able to go through the total acquisition. What information they're going to provide to you, such as tax returns, financial statements, and other key data analytics, so you can review and ensure that you do a proper due diligence on it. What the employee retention plan is going to be if there are employees to be retained, and when you guys ultimately want to close. And what the proper approvals are going to be, such as, are you inheriting a lease that's going to have to be approved by a landlord, or any other terms such as a franchise or what have you.
I generally tell people in the LOI to get a 30-day due diligence period to cover time to review all these financial documents that you're going to be provided, but then also give yourself 60 days to close. Most transactions are going to close within 90 days of your PSA or purchase sale agreement being signed, but we want to make sure that we have enough time. Even if we're targeting 60 days, let's make sure that we give ourselves enough grace that if anything goes wrong and say your accountant is on vacation and can't get you the tax returns right away, that doesn't sink the deal or cause contentious negotiations when you're supposed to be closing and you're asking the seller for an extension. Now that we've got our LOI signed or our purchase sale agreement completed, it's time to figure out, what is the funding going to look like? Now, realistically, you've already started to think about this before you got to the purchase sale agreement, but this is what your typical acquisition is going to look like with an SBA 7A loan. You're going to be looking at your equity injection as the buyer of being between 10 and 20% of the total project cost. So say you're buying a building with a business to go with it, and the total price is $1 million for both, you would be expected to put in about $100,000 of equity in. Now, we can also layer in a seller's note, as Aaron mentioned a little earlier. That's when the seller keeps a portion of the purchase price instead of it being funded by your equity or by the bank debt. Now, this often happens if the seller sees more upside than you may be willing to pay up front, or if you need a way to negotiate some kind of a disagreement in value. It's a very valuable tool to be able to bridge gaps. Then the balance of the loan would be your SBA 7A loan. For a acquisition that has no real estate behind it, you'll be looking at 10-year term and 10-year amortization. If you do have real estate that's at least 51% of the total project, then you will actually be eligible for 25-year term and 25-year amortization. So it's really important you know some of these nuances when you're trying to figure out your total stack. Now, in terms of the realities of putting together a deal, you need to make sure you know a few lenders or brokers you're going to be working with. Make sure you have a good relationship with the seller so that you're able to figure out a path forward. And make sure you have your equity up front. We don't need to spend a lot of time trying to scrounge up every quarter in the couch. Make sure you know where this equity is going to come from so that as you're evaluating your deals with your buy grid, you're not evaluating deals that you're not going to have that 10% for.
So aside from making sure that you bring enough equity to the table to get the deal done, in order to make sure that it's going to survive underwriting and continue to be a viable business, you need to make sure that the debt service coverage ratio, or DSCR, is going to be on track to hit the metrics required by your lender. Usually, banks want to see a 1.25, maybe in some cases as high as 1.5 DSCR ratio. And that really drives how profitable the business is and how likely it is to be able to service the debt. Again, bankers are cowards and they want to protect their money. One of the other considerations, too, is not just the purchase of the business itself, but making sure that you have enough runway for working capital. Usually, you want to have at minimum 3 months worth of expenses to allow for a transition period and be able to ramp up whatever new pipelines of revenue you want to generate, as well as cover any backlogs that may and slippage that may happen with the handoff from the previous owner.
A few things to keep in mind. The SBA now allows partial changes of ownership. That means that you can buy out maybe one partner with another partner remaining on, or partially buy out shares from two partners and become a third partner. If you are going to go down a partial change of ownership route, do know that the remaining owners will need to provide their full guarantee so that we will not be able to just take yours. In addition, seller's notes that are on full standby for the lifetime of the loan, that is going to count as equity into your deal and can help reduce your overall amount in. There's a few other tips and tricks as you get deeper in, so make sure you're engaged with an SBA professional as you're putting together the LOI and as you're getting ready to move into underwriting.
After the LOI gets executed and as you get closer and closer to that closing date, you're going to be undergoing what's called due diligence. This really means that you're going to be looking to ensure that the numbers you're basing your valuation off of and pretty much any other metric that's important to making sure the deal is done and represented to you properly is in fact as accurate as possible. The last thing you want to do is to buy a business that's representing $100,000 or $200,000 of profit when in reality it's half as much. Firstly, that's going to ruin underwriting for yourself. And secondly, that's just going to make your life miserable as you're going to be trying to pick up the pieces from an underrepresented disclosure. A lot of these types of potential errors that get uncovered aren't even malicious. At the end of the day, we're all human here for now. AI is knocking on the door, but sometimes just human error can lead to a significant impact during due diligence. One of my favorite stories is when I was actually working on a project for a client of mine, and this is where they had a large multiple for SDE. They had a 7x multiple because this was a multi-unit franchisee. During our due diligence, we uncovered a $30,000 P&L adjustments. Not because anyone was trying to hide anything, not because anyone was burying anything, but just because it became uncovered and there was human error. Well, when you're dealing with a 7x multiple, that totals over $200,000. And that actually impacted the purchase price for my clients. I've worked on several other deals where we find other potential, we can call them errors, mistakes, snafus, what have you, not things that'll destroy the deal, but could impact the purchase price. And sometimes my clients will actually take that to the seller, say, hey, listen, we found some problems here, but it looks like the purchase price should go down a little bit. Or I've had clients just put it in their back pocket. And if anyone tries to get smart at the closing table, my client has an ace up their sleeve to say, we're signing this deal right now. Okay, there's some things you want us to consider. How about we consider this missed expense right there? And so that's why due diligence is so important. It's the trust but verify piece of the puzzle. And when you're looking to buy an actual business, working with a competent accountant and a competent legal team to make sure that the operations, the financials, and the legal all tie out properly, or at least mitigate risk, is going to be crucial for you ensuring that this is the proper business you want to move forward with. Don't forget, at the end of the day, this is going to either become a large investment for you, your entire livelihood, or if for nothing else, if you're funding it with the SBA, you're personally guaranteeing it. So there's a lot of risk that you are taking on, and you absolutely want to make sure that you're covering all your bases.
Due diligence is your chance to ask questions. It's important, if not imperative, to not have fallen in love with your business yet, to make sure that you can ask the questions that need to be asked. We had a borrower recently who went out and asked to see the POS terminal of a business, and the numbers didn't match up to the P&L, an instant deal killer. But at least he figured that out up front before going through the expense of hiring a CPA and an attorney to draw up paperwork. Uh, Make sure that the licenses in place are still what's needed and nothing is being grandfathered in. Reach out to the customers and vendors. Try to make sure that this business does have a good reputation and that they're not stiffing their vendors and they're just waiting for someone else to fall on the grenade for them. Take a look at the people. Make sure that there's no one who's misclassified as a 1099 when they're really an employee. Make sure that there's no outstanding legal matters that you're not aware of. Check, do they have SOPs in place? What are their KPIs? And what is their tech stack? Can you easily replicate it and scale it? These are all things that are super important to making sure that your business works. And just keep in mind that having a lender go through and provide an approval does not mean that this is a business that you want to take on. You need to make sure that you are your own advocate and you're not just outsourcing all the due diligence, because there's a lot of people out there that would be happy to give you money just because the bank will be making more than you are. If you made it to this point, congratulations. You have a deal under contract. You've been able to get through underwriting, and now you're probably well into closing. You may think that you've made it through the hard part with your search, but I've been in this business long enough to know that literally anything can happen until you sign the dotted line. Some of the common deal killers that I've seen over and over again starts with unfiled taxes or payroll. If the company you're buying has an IRS liability, that has to be cleaned up before you can purchase it.
The company you're buying may not have represented a proper balance sheet to you. And during due diligence, you uncover that they were hemorrhaging cash and really using the equivalent of merchant processors or payday loans for businesses to help fund the business, when in reality, they were not profitable and bleeding cash.
Sometimes a landlord won't assign the lease. Maybe they have a new plan in mind for that spot. Maybe they don't like the tenant mix that's in there. But the SBA requires that we have a 10-year lease in place so that you have the option to stay into that spot for the length of the loan. Make sure that if you're going to need an extension, you talk to the landlord early so we don't get thrown a curveball 2 weeks before closing.
Make sure to avoid any key personnel walking out the door. The last thing you need to do is to be buying maybe a restaurant and the executive chef goes, "Great, I'm out of here."
If your workforce is misclassified and you're coming in with a bunch of contractors, that is a gigantic liability. Make sure you understand who is actually a W-2, who is a 1099, and figure out if anything needs to be fixed.
In a similar vein, that's a legal problem. The Department of Labor could come down on you. There's also undisclosed litigation. Make sure that your legal due diligence does proper searches to ensure there's nothing outstanding against the current seller, so you don't inherit any legal troubles. Even if you're doing an asset purchase, if you're buying the name of the business, which 9 times out of 10 you are, you're going to be taking over the goodwill and the name of that business. So even if the litigation doesn't necessarily follow you, if there's a damaging reputation that you're inheriting, that's going to really impact you post-close.
Does your business have commingled books? Maybe you're only buying 1 out of 3 locations, or they have separate unrelated companies that they just run through there because it's easier than filing new paperwork with the state. Make sure that if you're paying a multiple on SDE, that commingled is either backed out, removed, or those assets are included in the sale.
And also follow the money. Make sure you don't have sales that are just disappearing, cash going out the door without actual reasonable expenses. All of this comes into play during the due diligence period. And as we just touched on in our previous commentary, not all due diligence problems lead to the deal not being executed. But when you uncover things like this goes beyond some human error, some minimal negligence. Best case, this is just gross negligence and incompetency. Worst case, this is fraud, and you should run as fast as you can.
Absolutely. But hey, even when you control for everything, Aaron, there's still anything can happen. The craziest thing I ever saw was 1 week before closing, the property got eminent domained by the state for a new highway. A close second, I was closing a loan for a hotel. 3 days before closing, there was a room fire because one of the guests fell asleep with a cigarette. So, control what you can control, because due diligence is just that, what you have a hand in. The rest of it, just hope that the roll of the dice goes your way.
Yeah, we can't forget about that or other acts of God. I had a client of mine who purchased a wedding venue, and 1 month later, COVID-19 happened. One thing I really want to make sure you all take away from this as well is keep the human element in everything you're doing. Make sure you build a true rapport with the seller before the LOI even goes out, because that the sniff test of whether or not this person is someone you would do business with is paramount. Because chances are, if you're getting a bad feeling before you even shake hands, there's going to be something that could be uncovered after the fact. And also with building that rapport, you're going to help them to understand that you're working to get the deal done. Due diligence and trusting but verifying is always a tricky situation, because there's a lot of things that get asked of from the seller. And they just need to know that you're coming from the approach of, listen, I want to get this deal done. We've built up a good rapport beforehand, and now I'm just trying to do what I have to do to get this loan funded.
What really matters the most is the small things. Make sure you keep an eye on everything from how important the staff is to, does your neighbors like you? Is this something that is going to be exciting with the transition? Or are you going to have to win over a skeptical group of new coworkers or employees? Uh, Make sure that you also have a good feeling about the small things and keep your eye on them, as so many times that'll be the difference between success and a headache.
I'm Aaron.
And I'm Joe. Thank you for joining us for this first scripted Numbers and Nonsense, and we hope to see you next time.
Adios.